Hello, everybody. Welcome back. Stephen Morris with Advisory, and today we're going to talk about real estate investments and what type of mindset you need to have when you're considering either making your first purchase or whether you're considering what to do with your existing assets. So, if you're here watching this video, I'm certain that you're very interested in investing in real estate, and you probably have these dreams or visions of owning this successful apartment building that's throwing off so much money that you can just hang out at the beach while property management does everything and all the cash flow is just flying into your bank account so that you can spend it on cool things.
Oh, you'll tell them that we're at the Beverly Hills Hotel?
And I'm here to tell you that that future could be available to you, but it's going to take quite a bit of time to get there. And so if you're not prepared for that type of journey, then I'd recommend probably choosing a different investment class. With that in mind, let's go over what the typical life cycle is of a real estate investment and why the first 5 years of your investment in particular may just not be that exciting at all, and that if you hold it for a long period of time, you'll be a very happy investor. First, let's talk about how real estate has performed historically over the past century. Generally speaking, with the exception of some markets, real estate has gone up and gone up in a major way. Why? Number one, they're not producing more land. And number two, the fact that zoning is generally restricted in major cities, you're starting to see supply totally being outweighed by demand, and that the cost of real estate is just skyrocketing as a result. That being said, at times you might see the market go super high. So we're thinking about the years between 2004 up till the Great Recession of '08.
The market's in an itsy bitsy little gully right now.
And the whole housing market is about to collapse?
And then, of course, the past decade has been fantastic. Let's say 2014 all the way until 2024, you have seen real estate with a minor little blip. Real estate really skyrocketed as well. Does that mean that the real estate's always going to perform this way? Not necessarily. It's going to depend on certain conditions on the ground. But generally speaking, the longer you hold, the happier you're going to be. And that's historically proven out to be the case.
It's how I get the big bucks.
With real estate, there are typically two types of strategies that you might engage in. So the first one would be an appreciation strategy. Appreciation strategies typically involve buying stabilized assets in primary markets. Los Angeles, San Francisco, New York would be great examples of primary markets. Typically, when you're buying these properties, you're doing so at a very high price with a very low yield. And so as a result, you're typically being quoted cap rates that are, especially in today's market, at or even below the borrowing cost. So why would you ever buy something where the borrowing rate is higher than the cap rate, thus achieving something called negative leverage? Well, the reason being is that you're assuming that supply is not coming down the pipeline, which is going to kind of cut your legs out from under you in terms of valuation of your property. You'd assume that if you're buying at such a low cap rate, there probably isn't a lot of supply that's coming into the market, and you're guaranteed to find tenants to rent your facilities at a very high rate, and over time, probably a higher and higher rate. And so you'll see your property appreciate over time, even if it's generally producing no cash flow in its intervening or early years. This type of strategy is fantastic for long-term thinkers, especially if you have a business or you're in a profession that generates a lot of cash flow. Let's say you're a plastic surgeon pulling down $10 million a year as a celebrity. You probably don't care about the rental income coming off of your apartment building. It's a great problem to have. You're more than happy to buy something with a very low cap rate because you seek stability and appreciation over the long term. This type of real estate strategy I don't typically recommend to investors for their first-time properties, unless you have that situation like we talked about here, which is a significant amount of cash flow from an existing operating business. We typically would go for the second strategy, which is a high cash flow strategy. These type of strategies are typically found in secondary markets. So you might be looking at kind of the middle of the United States, where perhaps the cap rates are much higher than the borrowing cost, and so you're immediately able to be cash flow positive right after you acquire the property. The downside to that is you might be thinking, well, how could there ever be a downside? I'm getting cash flow every single month. The downside is that in many years from now, you're probably going to end up selling your property for a smidgen above what you paid for it. Why is that? Well, there's probably no restrictions on zoning laws in that particular state or city that you're looking at. There's probably tons of supply coming down the line. Cost of labor and cost of materials might be a lot lower over there. And so whenever demand starts to show up, supply immediately follows. Whereas when we're looking at cities like Los Angeles and San Francisco, when demand shows up, supply is nowhere to be found, thus resulting in much higher rents. Does that mean that the cash flow is a bad idea? No, of course not, because having cash flow is fantastic and conducive towards you building wealth we'd strongly recommend a mix of both strategies, but it's going to depend on your situation. It's going to depend on how badly you need the cash flow now versus how badly you'd like to have the appreciation later. As we know, appreciation leads to something else, the ability to borrow again on that property. So let's use the example of the plastic surgeon that bought an apartment building in Santa Monica at a 3.5% cap rate. And over time, that property might triple in value, and there would be an opportunity down the road to borrow against that asset to buy another property. That's fantastic. Whereas the cash flow situation, most likely it's not going to have that opportunity to do so because you're just generally not going to see the appreciation. Regardless, in either situation, in the first years, you're not going to see a lot of cash flow. Why is that? Well, as we know, the biggest barrier to entry in real estate is having money.
That seems mean.
If you don't have the cash, it doesn't matter how hard you want it, you can't buy the property. There are very few loan programs that would give you very, very high leverage. Those are typically reserved for single family homes. And when you start to move into apartments, retail, other sorts of ventures like that, you're going to start to see that you need to start putting significant down payment. So to that end, you're incentivized to borrow as much as possible from the bank, and the bank will typically limit how much they're going to loan you based on something called a debt service coverage ratio. And so if we're using an example of like 1.15, the bank is basically saying our loan payments have to be exceeded by your net operating income by 1.15. Let's say that the loan that you're seeking has a $10,000 a month debt service payment. You would have to have from the property $11,500 of net operating income in order to achieve a loan that has a monthly payment of $10,000. So what does that all mean? Well, if you have, for example, one vacancy, and let's just use an example of one vacancy on one unit, for 1 month, you're roughly out 8% for the year because you're talking about 1/12. Add an additional repair to the mix and perhaps a couple of other expenses that were unforeseen, and you might very quickly find yourself with very little cash that year. So why get into this business? Well, we know that over time, the economic outcome for you will improve. Rents will move up. Your mortgage will stay the same. And if you're in states like California, for example, your property taxes are generally going to stay the same too, which is a fantastic outcome. Now, it's true that repairs might move up, but historically what we're seeing here is that those other costs are being outweighed by the cost of those repairs. And so over time, you're going to see that the economics of your particular real estate investment are going to totally shine. And after 10, 15, 20 years, you're going to look like the biggest genius ever because cash flow is just so juicy, but it took you so long to get there. And the secret is you're not really a genius. You were just patient and had a very long-term mindset. Whereas in my opinion, most people don't find this mindset to be very alluring because they're looking for the quick return today. I bought a stock for $1 and it went up to 10, so I made 10x my money. Why would I ever do something like wait 10 years for a real estate investment play to work out? I'll leave it up to you to decide which one's better. In my opinion, typically the real estate investment has worked out, whereas most people have found themselves pretty much at a total loss when they're seeking these type of short-term gains or short-term returns in the stock market. I would be remiss to not mention one more thing. Although that's true that after you've paid off the debt, cash flow tends to be very light, it's also true that you're actually gaining value in the property month by month because as you start to pay down the debt, you are reducing the amount of debt on the property, which is increasing your equity. And so as a result, your financial position and your net worth is actually growing every single month, even though you're not seeing that cash flow start to hit your bank account in a meaningful way in the first 3 to 5 years. That is a powerful thing, which I believe is often overlooked. But again, you have to be comfortable with that and have a different cash flow stream or a different means of earning income in order to be able to not rely on that particular property to supplement your lifestyle, to supplement all the income that you need for the year. So if you've been patient enough and you've stuck with this investment for the next 10 to 15 years, you have an opportunity to dispose of it and buy a new property. And by using a 1031 exchange, which is unique to real estate, you're able to tax defer and ultimately tax avoid, if you hold it till death, any capital gains that you would recognize from the sale of your property. This particular area of the law, I think, is tremendous and is one of the main reasons why we're such a huge proponent of real estate here at AdviseRE. So to recap, what we've talked about here today is first, typically real estate investments are not so enticing in the first few years. That's typically year 5 when you're going to start to see a change in the outcome of your property, and that's when you're going to see a huge economic benefit. Number 2, Real estate is a long-term investing strategy, and if you have the mindset and the willingness to hold a real estate investment for a long period of time, you will see a fantastic economic outcome. Number 3, we know that even if the cash flow is not so juicy in the first several years, you are still profitable on this business, generally speaking, as long as you're continuously paying down the mortgage. Every time you make that mortgage payment, your equity is increasing, your liability is decreasing, and that's a fantastic outcome that we like here. Lastly, when it's ultimately time to dispose of the property after 10, 15, 20 years, or even earlier, depending on what situation you're in, you can utilize a tax-deferred exchange, also known as a 1031 exchange, which is unique only to real estate. So I hope this video helped you frame your mindset on how to look at real estate investments, and hopefully it helps you out when you're considering your next purchase, the type of mindset, the type of willingness you have to hold the asset, and that you're not relying on the cash flow of this property in order to achieve your long-term financial goals, which is hopefully to retire wealthy at some point. Hope this video helped, and please feel free to contact us here at this email below if you'd like to learn a bit more about real estate mindset, real estate strategy, or if you'd like to just generally discuss your thoughts with us. Thanks so much for watching.